Today, we're going to be taking a look at a few dividend ETFs that I often hear people talking about: DGRO, VIG, and we'll touch on SCHD. All known for dividends, but each going about it in a different way. We'll be taking a look at how they work, how they rebalance, recent changes, of course, the performance and expense ratio, and which one will actually make us more money looking back over 5 or 10 years. So, if you've been thinking about incorporating dividend investments into your portfolio, let's make sure that you're focused on the right dividend factor for your goals and needs. I am Lisa J. Stocks, and I'm here sharing my personal financial journey. Never financial advice, just my perspective, things that you may want to reflect on to make decisions concerning your portfolio. Okay, so let's get started. What is DGRO? It is the iShares Core Dividend Growth ETF. When it comes to DGRO, its goal is simple, but it's an important one. It tracks U.S. companies with a history of consistently growing their dividends, not necessarily by the highest yield. This ETF is designed for investors who want income that grows over time, not income that peaks early and then stalls out, basically staying stagnant. This usually means profitable companies with strong balance sheets and room to keep raising their dividends. This fund recently had its reconstitution, that rebalancing that removes and adds different holdings. And so they added 44 new holdings, about 7% of the funds, and removed about 43 slower moving names like US Bancorp, Target, Comcast, and General Mills, to name a few. So this fund is focused on protecting dividend growth quality. Its current yield is about 2%, but its focus is to stay on track for future growth. So taking a look at the top holdings, we have ExxonMobil, JP Morgan Chase, Johnson & Johnson, Microsoft, Apple, AbbVie, Procter & Gamble, Philip Morris, Broadcom, and Home Depot in the top 10. This fund gives us more exposure to financials and healthcare before we get down to technology. So this fund holds those large companies that may not pay high dividends now, but are built to grow dividends steadily over time. So you're getting dividend growth, but this is not a high income fund. Now let's take a look at VIG. And this is the Vanguard Dividend Appreciation ETF. When it comes to this fund, it has one of the strictest rules in dividend investing. So to be part of this fund, the company must have at least 10 consecutive years of dividend growth to even qualify. That creates extreme quality, but it also means that VIG can be slower to adapt. When it comes to this fund, it only rebalances annually, and the changes that it makes are rather conservative. You typically see a lower dividend yield than DGRO, lower turnover, but extremely reliable dividend payers are incorporated here. VIG is built for investors who value maximum dividend consistency, even if this means sacrificing growth. Taking a look at the top holdings when it comes to VIG, we have Broadcom, Microsoft, Apple, JP Morgan Chase, Eli Lilly, Visa, Exxon, Johnson & Johnson, Walmart, and MasterCard. This fund is most heavily weighted into information technology, financials, healthcare, and industrials. Now, let's make some comparisons between these funds along with SCHD. So I'm including SCHD in there because it is a well-known fund that many investors have been frustrated with because of the lack of growth, even though it is a go-to fund for consistent dividend payments. Depending on your age and stage of your investing journey, you want to have a bit of both growth and those steady dividends. So when it comes to VIG, they're incorporating those top tier that have proven themselves for 10 years at a minimum. DGRO is more flexible. It brings companies in earlier if the dividend growth looks to be sustainable. Looking at the last column here, we can see the dividend yield of the three funds that I've touched on today. SCHD has a higher yield and they all have similar expense ratios. DGRO at 0.08, VIG at 0.05, and SCHD at 0.06%. SCHD has a higher dividend yield at 3.8%, whereas DGRO and VIG are about 2%. Now let's take a look at the performance of these three funds against each other. Year to date, DGRO is up 14%, VIG is up about 13%, while SCHD is up just 1%. Zooming out to the 5-year, DGRO and VIG up about 56%, while SCHD is up 29%. If my videos help give clarity when it comes to investing and you're enjoying my channel, if you're not already, make sure you subscribe, hit the like button and that notification bell. So in looking at these three funds, I'm thinking about it like this. SCHD is more suited for someone who wants steady, consistent dividend income, but DGRO and VIG give you exposure to strong dividend paying companies. So you're getting dividends along with the growth because these companies are reinvesting their dividends and allowing us to see that compounding effect when it comes to our investment. As we saw, they all have pretty low expense ratios, so we're not going to be losing out a lot to those fees. And by choosing a fund like DGRO instead of SCHD, you might win out, even though it gives a lower dividend. DGRO as well as VIG are also giving us that stronger share appreciation. If you're in the building phase, whichever fund you're in, you're going to probably have on the drip the dividend reinvestment plan and be reinvesting those dividends. So you can think about having the security of a fund like SCHD when you're actually totally focused on collecting those dividends as income. But if you're in the growth stage, you might want to consider a VIG or DGRO while you're focused on building your portfolio, having dividend growth from those dividend paying companies, but also the share appreciation. So what is your focus right now? Growing your portfolio or collecting those dividends as actual income? Take that into consideration, deciding on the balance of how much exposure you're going to have in your portfolio to different funds like this, depending on your age, risk tolerance. Investing is not a one-size-fits-all thing because we all have different needs, expectations, time horizons when it comes to our investing. We're almost at the end of 2025. Let me take a quick second to say Happy New Year, and I hope to see you back here in 2026 as I continue on this journey to build wealth and strive for financial freedom for myself and my family. Make sure to leave me some comments. Let me know your thoughts on the funds that we took a look at today. What factors are you prioritizing right now if you are in the building phase and steadily reinvesting all of your dividends? Make sure to check out my referral links for MooMoo if you're ready to open a new account. Consider joining channel membership to support the channel and have access to additional content. Thanks for watching. Okay, bye.